Welcome to the Deep Dive. We're here to get you genuinely well-informed, maybe with a few surprising facts, maybe even some humor along the way. Today, we're diving into something really fundamental, but, it can often be perplexing. The whole world of client investment accounts. If you're looking to navigate your financial decisions with more confidence, understanding these structures isn't just, helpful. It's really, really key.
Absolutely. And our mission today is basically to demystify all this for you. We'll touch on everything. Accounts defined by credit, accounts for specific goals like, say, education, and even the different ways they're legally registered, individual trust, the whole range. The goal is to give you those essential nuggets of knowledge so you feel properly informed about the choices out there.
Okay, let's start unpacking this, maybe with the simplest one first, the cash count. Now, most people probably get this one, is where you just pay the full amount for securities, no borrowing from the broker-dealer involved. Pretty straightforward. But the timing is crucial, right? Regulation T says payment is due within 2 business days of the settlement date. S+2, they call it. So buy shares today, the money's got to be there in 2 days. What's the thinking behind that strict timing? Is it just logistics?
Well, it's mostly about keeping the market running smoothly and frankly stably, that S+2 deadline. It's kind of the market's heartbeat for settlement. It really cuts down on the risk for broker-dealers. The risk that someone won't pay up, it keeps capital moving. Without it, things could get messy, like a domino effect of failed trades.
Okay. Now, moving on to something maybe a bit more, dynamic. The margin account. This is where it gets interesting. Your broker-dealer actually lends you money to buy securities. And the securities you buy, they become the collateral for that loan. It's a powerful tool, definitely. But yeah, it comes with some big considerations.
That's exactly right. Margin definitely boosts your purchasing power, lets you control more assets with less of your own cash up front. But, and this is the big, but it also magnifies your risk. If those securities drop in value, your losses get amplified just like potential gains would. Regulation T applies here too. Generally, you deposit 50%, the firm lends 50%. And just like cash accounts, you've got 2 business days after settlement to get your part of the money in. So, $10,000 stock purchase, you typically need to deposit $5,000. And it's good to know the difference between long and short positions here. Long is when you borrow funds to buy shares, hoping the price goes up. Short is different. You're actually borrowing the shares themselves to sell, hoping to buy them back cheaper later. For either, there's a minimum equity requirement. Usually your account needs at least $2,000 in equity for any loan, whether it's cash or stock. For buying long, your initial deposit is the lesser of $2,000 or 100% of the purchase price. If it's a small purchase, say $1,500, you paid the full $1,500. For selling short, though, it's a flat $2,000 minimum deposit.
Right. And you can't just decide to use margin one day. You have to sign specific margin agreements first. There's a credit agreement. That one's pretty logical. It lays out the loan terms, interest, how it's calculated. Then the hypothecation agreement or pledge agreement. This basically says the securities you buy are collateral for your debt. But here's a detail I find interesting. It allows the broker-dealer to rehypothecate, meaning they can use your securities as collateral to get a loan themselves, maybe from a bank. It sounds technical, but it means they're not just sitting on your collateral. They might be using it within rules, of course, for their own operations. And the third one is the loan consent agreement. This lets the broker-dealer lend your securities out to others, usually for short selling. Now, the crucial thing here is that signing this one, it's optional. If you sign it, you give up your right to vote on that stock while it's loaned out. So something to consider. And it's worth remembering, even if you're only selling short in a margin account, not borrowing cash, you still need that margin agreement because the firm is lending you the actual stock.
Yeah, exactly. And that leads to a really, really important point. The risks. What are the big risks you absolutely have to know about with margin? Firms are required to give you a margin disclosure statement. You should read this carefully. Think of it as the what could go wrong list. First, you can lose more money than you put in, significantly more. Second, the firm can force the sale of your securities or other assets in the account if you get a margin call. They don't need your okay at that point. Third, and this surprises people, they can sell those assets without telling you beforehand. Fourth, you don't get to pick which assets they sell to meet the call. The firm decides. Fifth, the firm can raise its own internal maintenance margin requirements whenever it wants without giving you prior written notice. And finally, you're not entitled to extra time to meet a margin call. The deadline is the deadline.
Wow, that is quite a list. And it really hammers home why you need to understand this stuff before you jump in. Because when the market turns down, those rules become very real, very fast. And it's not just financial risk, right? There's emotional pressure too.
Sure.
Getting that forced sale notice, it's tough. Okay, speaking of risk, let's pivot to options accounts. We have to stress this. Options trading involves a high degree of risk. Buyers can, and often do, lose their entire investment if the option just expires worthless. Definitely not for novices.
Absolutely not. And firms know this. They have a very specific approval process before they even take an options order from you. It starts with a registered rep gathering your financial details, your investment background, basically assessing if you understand the complexity and if you're okay with the risk. This info usually goes into an options agreement form. The rep fills it out, sends it to you to check and sign. And here's the key timing bit. Within 15 calendar days after your account is approved for options, the firm must get a written acknowledgement back from you. It basically confirms, the rules of the road for options trading. It's a safeguard, really.
All right, let's talk about who's actually calling the shots on the trades. We need to distinguish between non-discretionary and discretionary accounts. Non-discretionary is probably what most people think of. You make every decision. Your rep might suggest something, but you have to say yes or no before the trade happens. But with a discretionary account, you've given written permission trading authorization to a representative to make those buy and sell decisions for you.
Exactly. And if a firm allows these, there are strict rules. A principal, like a manager, has to accept that written authorization before it takes effect, before the first trade. Then every single discretionary order needs prompt approval from a principal, usually same day, not ahead of time, and they have to review the account activity frequently. Keep a close eye on it. This authorization can be limited, which means the rep can place trades but can't pull money or securities out. Or it can be full, which allows them to trade and make withdrawals. Both types need that written authorization signed by you, the account owner.
Now, a big worry with discretionary accounts is always churning, excessive trading just to generate commissions. So how can you, spot potential warning signs? Maybe before it gets to an obviously illegal level, what should you be looking for?
That's a really good point. Officially, churning is judged by the number and size of trades compared to your investment goals. It's about the frequency and suitability, not necessarily about whether you lost money on the trades, but subtle signs. Look for a high volume of trades that don't seem to line up with the risk level or the long-term strategy you discussed. Is your portfolio constantly shifting without a clear reason, like a major market change? Are there lots of short-term trades in an account you meant for, say, retirement savings? Ask yourself, do these trades genuinely seem aimed at my objectives? Or do they feel more like they're just generating activity and therefore fees? That's the gut check.
And there's a very specific rule about conflicts of interest here too, right?
Sure.
If a firm is selling its own stock, like in an IPO or secondary offering, and they want to put that stock into your discretionary account,
They absolutely must get your specific written consent before doing that trade.
yes. It's a crucial protection against the firm potentially prioritizing its own interests, but there's also a neat little exception called the time price exception. Some call them not held orders. Let's say you, the customer, specify the 3 A's. The asset, like IBM stock, the action, buy or sell, and the amount, say, on 100 shares. If you specify those 3, but leave the decision about when during the day to trade or the exact price up to the representative, well, that's not considered a discretionary order. So it doesn't need that prior written authorization we just talked about. These not held orders are generally only good for the trading day they're given unless you provide written instructions saying they can last longer. It's like saying, buy me 100 IBM, work the order today.
Okay, so we've covered account types, who's in control, but what about the cost? How do you actually pay for brokerage services? There are mainly 2 ways this works. Right. You'll mostly see fee-based accounts and commission-based accounts. A fee-based account means you pay a set fee, usually annually, based on the total value of assets in your account. Maybe 1% of assets under management, for example. It doesn't matter how many trades you make. A commission-based account is the opposite. You pay a specific charge for each transaction, could be a flat rate per trade or a percentage of the trade value. Which one is better? Well, it really boils down to your investing style. If you're more of a buy and hold investor, not trading very often, paying commissions per trade might actually be cheaper. But if you're a really active trader making lots of moves, that fee-based account could save you money because your trading costs are essentially capped by that percentage fee. You might also hear about wrap fee accounts. These bundle everything together, advice, brokerage, admin costs, into a single fee, again, usually based on a percentage of your assets. Simple, convenient, but you might pay a bit more for that all-in-one package.
Okay, great. Let's shift gears now and talk about investing for the future, specifically for education, using these account structures for longer-term goals like saving for kids or grandkids.
Yeah, good topic. First up is the Coverdell Education Savings Account, or ESA. Important point. This is not a retirement account. It's specifically designed for education savings, elementary, high school, college. Contributions are after tax, meaning you don't get a deduction now. There's a limit, currently $2,000 per year per child who has to be under 18 when the contribution is made. And there are income limits for the people contributing. The money grows tax deferred, and withdrawals are tax-free if used for qualified education expenses. Now, if the money isn't used by the time the beneficiary turns 30, or if it's pulled out for something else, the earnings get hit with ordinary income tax plus a 10% penalty, though you can avoid that penalty by transferring the funds to another eligible family member who's under 30. What's really interesting about Coverdell's, though, is that the investment choices are self-directed. You have a lot of freedom in how the money is invested, unlike some other plans.
And then there are the really popular Section 529 college savings plans. Again, not retirement accounts, but super flexible tools for saving for education with federal and sometimes state tax advantages.
Exactly. These are typically run by states, but they cover costs for college and now even K-12 education. Like Coverdell's, the money grows tax deferred, and withdrawals are federally tax-free for qualified expenses. And qualified has gotten broader lately. It includes computers up to $10,000 a year for K-12 tuition, even a lifetime limit of $10,000 towards paying off qualified student loans, plus cost for some apprenticeship programs. So, quite versatile. A huge plus is their flexibility. You could live in California, invest in Utah's 529 plan, and your kid could go to college in New York. It works nationwide. Really helpful for families planning ahead.
So we've looked at what kind of accounts exist. Let's switch to who owns them and how they're legally registered. This ownership structure has big impacts on control, taxes, and what happens down the road.
Right. Let's run through the main types of customer account registrations. First, the simplest, individual account, opened by one person for one person. They're the only one directing activity unless they give someone else power of attorney, that sort of thing. Direct control. Then you have numbered and nominee accounts. These offer some privacy. You might trade under a number or a different name. But, and this is important, under the Customer Identification Program CIP rules, the firm must still know and keep records of who the actual beneficial owner is. So, privacy from the public, maybe, but not from the regulators. Joint accounts. More than one owner. They don't necessarily own equal shares. Usually, any one owner can place trades or give instructions. But for things like transferring assets out, usually all owners need to sign off, and all the tax reporting goes under just one person's social security number. There are two main types here, and the difference really matters for estate planning. Joint tenancy with right of survivorship, JTWRS, very common for married couples. Each person owns 100%. If one passes away, the account automatically belongs entirely to the survivor. No probate needed for that account. Smooth transfer. Then there's joint tenancy in common, or TENCOM. This is different. Each owner has a specific percentage. If one owner dies, their share doesn't automatically go to the other owners. It goes into their estate and gets distributed according to their will. So it might go to their kids, not necessarily the other account holder. It involves probate. Okay, what about entities? Corporate or institutional accounts. Here, the corporation is the customer, not the person opening the account. You need a corporate resolution. That's a document from the board saying who is authorized to trade in the account. Now, if the corporation wants to trade on margin or use options, they also need to provide their corporate charter. This document proves the corporation is legally allowed to engage in those activities. But just for a basic cash account, only the resolution is needed, not the charter. It's about verifying authority and legal capacity. Partnership accounts are similar in principle. You need info from each general partner. And you need the partnership agreement, which spells out who has the authority to make transactions for the partnership. Again, establishing clear lines of control. Trust accounts. These involve a trustee managing assets for beneficiaries. To open one, the firm needs proof of the trustee's authority and a copy of the actual trust agreement, the legal doc that sets up the trust. Two main flavors here, with big differences. Revocable trusts, also called living trusts. The person who set it up, the grantor, can change it or cancel it any time. The key thing. Assets in a revocable trust are still considered your personal assets for things like creditor claims and estate taxes. Flexible, but maybe not the best for asset protection or tax reduction while you're alive. Irrevocable trusts. Once signed, these generally cannot be changed. People often use these to move assets out of their estate, potentially lowering estate taxes later on, because once the assets are in there, the grantor doesn't legally own them anymore. Less flexibility, but potential tax and protection benefits. And finally, custodial accounts under UGMA or UTMA Uniform Gifts Transfers to Minors Act. These are for minors because kids can't legally open their own brokerage accounts. An adult donor makes an irrevocable gift cash securities to the minor. An adult custodian manages it. Rules are one custodian, one minor per account. The donor can be the custodian. There's no limit on the gift size itself, But donors might face gift taxes if they give above the annual exclusion amount, which is $17,000 per donor per recipient right now. The account uses the minor's social security number, and the minor is technically responsible for taxes on earnings. The custodian manages it and can even get paid a fee if they aren't the original donor. An interesting point here, the custodian can actually grant trading discretion to a qualified third party, like a registered rep, so they can delegate the investment decisions. But, and this is a firm rule, custodial accounts cannot be margin accounts, ever. That means no buying commodity futures, since they usually require margin, and no short selling, because that also happens only in margin accounts. It's all about protecting the miner from those higher risk strategies involving borrowed money or shares.
Wow. Okay, that really covers a lot of ground. It just shows the surprising depth, the sheer variety of account types and structures out there. And understanding all this, it's not just about learning the terminology, is it? It's really about feeling empowered to make choices that actually fit your life, your goals, your vision.
Exactly. If you connect the dots, you see how each type serves a different purpose. Each comes with its own set of rules, its own risks, its own benefits. Thinking critically about your own goals, your comfort level with risk, and then seeing how these structures either support or maybe even hinder those goals. That's the key. Knowing these details can genuinely make a difference in reaching your financial objectives safely and efficiently.
Well said. So here's something to think about. Now that you have this deeper understanding of account structures, how might that change the conversation you have with your financial advisor? How can it empower you to ask sharper, more specific questions, making sure your accounts truly align with your long-term plans and your risk tolerance instead of just relying on, basic assumptions? How does this knowledge let you really take the wheel of your own financial future?